This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I'm your host, Scott Meyers. In today's episode, we're going to attempt to explore the mindset of our investment partners who join us in our syndicated projects. Clearly, the landscape has changed, and in our ongoing efforts to provide an investment vehicle that is both safe and profitable for our partners, overcoming the fear and concerns about COVID-19, the looming recession, social unrest, all in an election year has proven to be challenging at best. So to help us unpack the state of private equity, I reached out to my friend Glen Mathers with NuView IRA to provide a bit more clarity. Glen is the founder and CEO of NuView IRA and has been its leader since 2003. In 2018, he also created NuView Trust, expanding the growing business of self-directed IRAs into new services to further reduce or eliminate taxes. His clients invest in real estate, notes, private placements, precious metals, LLCs, and a multitude of unique assets with the aim of growing wealth without taxation. He holds a BS in business management and a master's in information systems from the University of Southern California, and after working in various corporate finance and strategy positions, Glen decided to create opportunities for individuals to invest their tax-advantaged funds in non-traditional markets, just as he had been doing himself for several years. And his messages resonated with over $1.4 billion worth of assets directed on the platform of NuView Trust, and as a result, Glen is a sought-after speaker at live events, podcasts, and radio, where he passionately shares the power of personal choice and reducing the negative impact of taxes while building wealth. Glen is married and has 4 children and lives in Mount Dora, Florida, and gives back by raising money to buy and ship wheelchairs around the world through his charity, Share the Love, that has donated over 3,500 wheelchairs in 6 countries so far. So without further ado, let's dive into my conversation with Glen Mathers of NuView IRA. Glen, good to see you again. Welcome to the show.
Thanks, Scott. Really happy to be with you.
Well, I know that everybody has been extremely busy, so we're very thankful that we're able to get you and to sit down and chat for a little bit about what is happening in the world of self-directed IRAs. And so I've given everybody a little bit of background on yourself and on NuView. So if you would just take a few minutes and kind of fill in the gaps and let us know what you've been up to since the last time you and I talked.
Sure. And, just to kind of throw some breadcrumbs behind us, it's been about 17 years since I started this. I'm kind of testimony that you can change paths and redirect your careers even in midlife. And that's what I did when I started NuView. And I got into this business, Scott, because I loved the fact that I could pick and choose my own investments. And, usually those investments come with education. And that's why I'm here today and why I put such value of learning about what you do and what you offer your clients. Because the whole concept of self-storage never dawned on me 17 years ago when I started. And I saw your 15-minute presentation during one of our events, and I was just blown away by this sort of structure on how you build this and how you justify it. And the real exciting thing is that people have a choice to come into this. And the reason I started the company is all these funds are locked away in Wall Street, and you had to swallow what they were dishing up, and I didn't like it. I had to buy everything at retail price and buy everything based on everybody had the same amount of information. Quite frankly, when I invest, I like to have more information than everybody else, not the same amount. And I feel like by people taking control of their assets and taking control of their choices and doing so in a way that's well-informed, it's magical about what can happen. So we're the platform. That's what we do. We don't offer investments. We don't offer advice or counsel. We'll talk all day long about the type of IRAs you should be in. But outside of that, it's people like you that actually bring value to self-directed IRAs. So I'm really happy to be here and learn, quite frankly, a little bit more about you as I am your guest today too, Scott. So it goes both ways.
Perfect. Well, it all starts with a question, doesn't it, Glen? And all businesses usually are a result of a need that we have for ourselves and our own business. Most entrepreneurs start that way. And if you're anything like me, which it sounds like when you begin looking into the best ways to make money and planning for retirement, you either swallow what Wall Street tells you and then taking enough lumps there, you realize and you begin to sit back and think there's got to be a better way. And therein lies the question and the search, and therein lies a whole business that you founded. So Congratulations. And on behalf of all of us investors out there that would like to be able to direct our own investments, I want to thank you for the journey you've taken.
Oh, you're welcome. It's a lot of fun and it changes every day.
Well, so, I'm a follower and a student of Robert Kiyosaki. And, he, by way of anybody that is, anti doing anything from the establishment, it's him. And that kind of started my journey in learning that there's other ways to invest from the stock market. And that starts in real estate. And then when I got to the place where, you can invest in real estate and your growth is really only capped by the amount of capital you have. Your credit's good, your credit scores are good, the banks will give you the money if the project's cash flow, but eventually you run out of down payments and the equity piece. And if you want to grow and grow at scale, and especially in commercial like myself and the folks that are on this podcast, you might be able to do one or two before you've exhausted your capital. And then you have to learn how to go out and raise capital from other folks. And if you've done a good job in your business and you've got a good story to tell and a good deal, then it's up to us to then show them that vehicle that they can utilize to convert an old Roth that they may have had or some other investment funds, and to be able to self-direct that into our projects. And that's how I was introduced to it, again, out of necessity once again, and then this platform like yours for folks to be able to invest. So if you would kind of bring us up to speed on, the growth that you've seen in the 17 years, are there any markers in that, or, maybe touch on the legislation along the way that has really been a catapult or a springboard for folks getting into this side of the business?
Okay, do me a favor and make sure that I don't forget that exact question, because when you mentioned Robert Kiyosaki, I've just got to backtrack for a minute and tell you two of the things that he's had a lot of impact.
Mm-hmm.
And I think the biggest impact that Robert's had is question everything. Don't assume. And basically he says, if you see a line forming, get out of it, because it's not likely leading you to a good place. It's leading you to the place where everyone else is. Two things that I remember that he says. One is that if you think you have a really important job, try selling it to somebody. In other words, we get caught up about how we make money and our position in the company, and we realize that we're doing that at the mercy of somebody else's decision. So as an employee, that's another part about investing. It's not just about the future. It's about now. It's about giving you options to be able to step out of that job that you have that's a dead end and maybe go find something yourself. And the reason you can do it is because fundamentally, not only have you saved, but you invest in things that grow. So it's more than just retirement, The second part of this goes to the point that you talked about syndicating, and you just touched on it lightly. And that's the fact is that generally speaking, you will be limited less by your ideas than more by your cash, right? A lot of people are limited by ideas. You're not. And so after a while, like you say, self-storage and commercial ventures, you run out of money really quick, faster than you would buying a single family home. Even those you run out of money, so you need to go find it. And Robert talked to me, I was actually having a meal with Robert, and I've had a chance to get to know him a little bit better. And he said, people don't understand that when they come to me and ask for money, first of all, their knees are knocking because they're asking Robert Kiyosaki for money. That seems like dangerous. And if you know Robert well, he doesn't suffer fools lightly. you have to kind of deal with him. And he says, but you don't understand. If you've got a well thought out plan, and he says, I don't care if it's on the back of a napkin, but if it all makes sense, I welcome that. One of the biggest problems that people have that have money have no time to learn how to invest it. So if you're soliciting people's money, you're doing them a favor. If you're putting them in something that's earning them, 6, 7, 8, 10, 12%, are they getting that in the market with the kind of risk portfolio that you're giving? If the answer is no, you're doing them a favor. Stop thinking that you're bothering me and start understanding that you're honoring me by asking money. And that was sort of an eye opener for me, because I'm always sensitive. Mm-hmm. Business and all that kind of stuff. But fundamentally, he said, no, you are doing people a favor.
And that's probably one of the biggest mind shifts. And I guess I probably had to overcome that in the beginning. But being on both sides and realizing, the losses that I took and the lumps in the stock market, or coming out even, and what, the average returns are, then looking on this side, thinking you're right. Hey folks, I've got a hard asset that produces income that you can see, touch, and feel. And for myself, I know the manager and I know if somebody's cooking the books or not, because if they are, it's me, and I meet with the manager every morning, and that's not happening. And so as an investor and equity partner in our businesses, we open the books, we show them the project and the deal. And you're absolutely right. You need to come to them with that confidence that you are offering them an investment that is far superior to most things out there in terms of even your projected returns based upon past history of a project, of a property. And at the end of the day, it's something they can see, touch, and feel. And, historically, you can look back at the track record of returns on these existing facilities. And although you can do that in the stock market, all it takes is one bad press announcement or somebody cooking the books, and they get punished. And so do you along with it. So it's all about the mindset and how you go about doing it. I mean, certainly you have to have all of the stats behind you, but I see so many folks that feel a little bit timid, and if they don't sound confident as they are presenting it, then the person who may be investing with them probably recognizes that maybe they're not so confident in the deal as well. So you touched on a piece that I didn't want to go too far on a rabbit trail on, but that's at the heart and soul of what we do. And there's a lot that goes into the back end of preparing for that, but you're absolutely right.
I will answer your question. I do recall it. It has to do with business cycles and where we are now, what I've seen over 17 years. And it is absolutely the opposite of what I thought it would be, which was I thought that the way it works is that a lot of money goes into retirement plans during the good times and stuff, and that in bad times, then people will stop investing. It will not be good business for a self-directed IRA custodian, and we'll wait for good times. Well, what's been interesting is about 4 years after I started this company is we hit the 07, 08, the real estate bubble, everything went down. We grew faster through that time than we did. And that was because, there wasn't a big governmental bailout at that point in time. There was for some businesses, but not small businesses, certainly not for individuals. So what happened in the market of Central Florida, where we're located, but we have clients all over the country, is that in Central Florida, our median price house got cut in half, and it got cut down to about 130. And it basically took 7 years for that to come back. 7 or 8 years, long time, slow. Although it was great to have a recovery, it was painfully slow, I think, for most of us that remembered it. But we kept growing, but our greatest growth is in market disruptions. Because think about this, we are custodying assets that are not traditional assets. So you would have to leave Charles Schwab and Merrill Lynch and all of the traditional brokers to come over and move your money over here. And what causes that movement is uncertainty. Here's the bad part about what's going on right now, Scott, and it feels good, but it's really bad. And we're awkward because we got a lot of money dumped into our economy artificially. The government printed a lot of money. And that's one of the reasons why, if you have hard assets, hold on to them, because we don't know what's going to happen next, whether it's inflation or further weakening. We don't know. But here's the problem is when the government writes all of these checks to everybody, which I understand why they did it, but there's repercussions from it. Unlike 06 and 07, when it got to this point, it means that we don't really know the typical the stock market is way higher, in my opinion, than it belongs, because the price earnings ratios are just going through the roof because they're not earning. A lot of these mutual funds and stocks aren't earning. I'm definitely afraid what's going to happen. I don't think everybody's caught on because they generally react, the public reacts as a herd. The public hasn't gotten out of the stock market. They're scared because cash doesn't pay anything. A 5-year CD averages right now at 0.5%. Do you want to lock your money up? It basically says you basically get to store it free. That's kind of where we are with money. So I think that right now people tend to be frozen in place and they don't know where to go. So these alternatives to say, when I saw your presentation that said, when do people store stuff? Well, they store stuff in times of uncertainty. They store stuff in times of transition. Mm-hmm. The Generation X store stuff and millennials store stuff. And of course, you know that the old guys like me, we love to store stuff because we've gathered it all our lives and we hate to get rid of it. So in other words, you take a look at those industries that are supported by this level of uncertainty, and that's where you need to invest. And that's what we see our clients doing.
Mm-hmm. Boy, that makes sense. I haven't really looked at it that way, but you're right. Disruption causes people to really do many things: either panic and pull back, or dig in and pull their cash back and say, "Okay, economy's been going along very well. Stock market's been going well." Those guys make the decisions, but then when there's a disruption, they feel the need that they need to begin now taking a look, dig back in, and that maybe they do need to direct their investments again. And the best way to doing that is to make sure that they get a hold of all their cash before it dwindles down to nothing if the market is going down. So interesting point. Interesting point. So let's talk about, there's a big question going on that I think nobody knows. We don't have enough history, at least on our end, or enough data. Those of us that are syndicating and doing real estate deals. So folks have pulled out of the stock market, and even though it's gone up and down, there's people that are still kind of playing in it. Some people that are sitting on the sidelines, sitting on cash right now. In the past, when that has happened, when the stock market hasn't been the place to go, then people would get into a self-directed vehicle. They would invest in hard assets like real estate, and it was kind of a natural migration. This time around seems to be a little bit different. There's a whole lot of cash that came out of the stock market. Some went back in. There's a lot sitting on the sidelines. And in my theory, and again, I don't know if I can disprove this or if you can disprove it or prove it, is that the money is still sitting on the sidelines. And we have a webinar and we're hosting a presentation for somebody to invest with us on a project. We have record number of attendees that show up on the webinar. We have a record number of folks that are pulling down packages through our portal, but the capital's coming in slow. They're asking more questions and doing more due diligence, which I'm thankful for. I think people should be doing this quite honestly, more often than I think they have in the past. But it seems at this time, people are still just not willing to part with the cash. And I don't know, Glenn, if that's record number of layoffs and unemployment and still so much unstable and lack of clarity. What are you seeing out there? What are your thoughts on that? And is there enough data behind us now, 3-4 months into this, to really be able to make a theory behind it?
Well, we kind of have the world's worst situation now. When you think about it, I think it's fear that's causing people to freeze. I don't think it's well thought out logic. It's fear. So think about, we have the perfect storm. Of course, COVID alone, if it happened 2 years ago, it wouldn't matter what president was there. Still pretty much an unknown thing. I kind of laugh when I watched a little bit of the and this is going to take this presentation. I watched a little bit of the DNC, and they compared SARS, the way that SARS was battled, to COVID, which are two different things. It's like saying, tuberculosis and cancer, and comparing those two things, and you can't really do that. So it's not so much who's in charge, and who's in charge really won't affect your investments that much. But you have all that sort of partisanship playing out, and then you have the unrest in the streets, and you have that on top, because that ignites fear probably more than unemployment, like civil unrest, because we've had unemployment before, but this generation has not experienced not since the 60s and the 70s. And this feels even a little bit different than that, those of us that kind of sort of remember. So I think what we're seeing is a natural reaction to that, Scott. I think what we're seeing is they're waiting to see some momentum going in one direction, and they're wanting to find out it's going to be better. They want someone to say it's going to be better. And I think that's fundamentally who you're going to vote for, is whoever you think is going to make you feel better and more secure. And it just depends on your political persuasion. I don't mind. I'm going to be here no matter what president. I'm not leaving the country. I'm not going to do any of that. But in fairness, I don't think people will sit on money much more than about 6 months longer. Mm-hmm. I think that if COVID's here to stay and there is no vaccine and we're going to live with it, I think we'll learn to live with it, and it'll start to be less of a noise, mm-hmm. less in our head. And we'll go on to another news cycle and we'll deal with a few deaths and we'll deal with it. And we're not there yet, because it's too ignited in our minds. There's political advantages to be sought on either side about whipping this into a hysteria. There may be something on the right side that says, let's whip all of these conflicts and riots, and let's put that on the front page because that benefits us. On the other side, let's take a look at every death and make every story unique and personal on the COVID side, because that indicates that the other side is not leading the fight against COVID. You know what I'm saying? Mm-hmm. And that leads on the news. It won't matter what side of the aisle you're on. And until that goes away, I think it does affect the money coming into the market, because we know it's not earning any money when it's sitting there.
Right. So here's a question I'll ask. I don't know if you can or if you dare to answer, and that is with regards to just the movement of money that you're seeing in the investment markets right now, and perhaps specifically at NuView, you've got a lot of accounts, I'm assuming, that are opening up, a lot of money coming in.
Yeah.
Do you track, do you have data on the movement of money that is going out? And if that's not a question that you can answer, then let's just talk in a broader sense on the investment side. The money's still there. It's just in different places. Tell us a little bit about, just the movement of money that you're seeing right now, whether it's internal to NuView or just in general in the market.
Any different for us. I mean, don't forget that what you see people doing it's the same people that are our clients too. And I think we're seeing the acceleration of different investments they're going into slow down. People aren't selling, people are holding right now. And it's not that they don't like alternative assets. They're just not certain where to make the next bet. And it's really funny. I look at investing completely different. When I was 30 years old, it was all about appreciation. It was all about that, right? And things change, right? You either lose hair or get gray, right? Mm-hmm. So, and both of us are in that category. Mm-hmm. Now we start to see I don't enjoy going in and out of investments, in and out, flipping things, right, trying to buy low and sell high. I always try to buy low, but don't let buying low get ahead of buying at the right price for the cash flow that you get throughout the life of the investment. Mm-hmm. Those people that are invested in those cash flow things aren't selling them.
Right.
But it hasn't gone on to say, why aren't you investing more of it? Mm-hmm. And here's what happens with investment dollars that I don't think people. Investment dollars are like a room at the Holiday Inn. If you own the Holiday Inn and you have a room, it either gets rented or it gets unrented, right? It doesn't get rented. Now, you could rent it and you could discount it through Hotwire or any of these third parties, for let's say $100 rack rate in that room, you might sell it for $50. You got $50 out of it. The only cost is to clean it, right? And so what happens is with cash, it's the same thing. You can sit there and really agonize about what to invest in, but you missed that night and the next, all of those days that's not invested, just so that you could think that you can make it all up by making a better investment choice by waiting. And I would suggest the waiting part ought to be the educational part. And as soon as you're educated to make that decision, go and have the money work for you. Because I think it's a long time before you're going to be able to see, people are always waiting for the economy to tank and then they can pick out all the great stuff. And there's valid reason to keep some of the cash dry. There's no doubt about it. I think that a lot of people have been missing it because they're not invested on good things that generate the cash flow right now.
And that seems to be one of the questions, or that balance that we're trying to always find the right offering for our folks, and even the direction of our company. And we can put a lot of projects. I mean, personally, for ourselves, development projects. Well, that's all delayed gratification. If we syndicate, we may get some fees along the way to sustain, to keep the back office and the operations going. Right. But we don't make money until 2 or 3 years down the road when it begins cash flowing, and then really the big pot at the end of the rainbow is in that year 5 when we stabilize the asset and either refinance it or sell. And so for ourselves, we'd like to have cash flow and a good mixture of that, and investors assuming the same thing. Some of these folks they've converted an IRA, and it's all just wealth building, to really double down and increase that pot for the time when they begin drawing on it. And there's others that are looking for an existing self-storage facility that we have, a project that we have that is producing cash flow now, or it's a turnaround and 3 months from now it's going to begin producing distributions. And so heading into the environment that we're in right now in COVID, our assumption was to change that mix and to find more undervalued facilities. And we had some of the folks, again, and thank you for saying gray haired like you and I. Mine's just going. It's just flat out going. But I appreciate that. The folks that are in the self-storage business that were they had sold, it was a seller's market, and they had sold at throughout the past 7-8 years. And then the last hanger-oners, begin to then start selling their facilities. And we saw a rush of projects come to market. And so we snatched up a few of those and put them out there, and they were strong cash flowing projects at a strong IRR, and didn't get the response that we thought we were going to get, assuming that there was other folks that had to replace perhaps an income because the unemployment rate was high, or just knowing that there's a safe bet when it is producing income. So, what would you say to that right now? Are you seeing more folks that is there, I wouldn't say a panic, but are there more folks that are looking for the cash flow because it is, it's safe if it's coming right now, or there's people that are needing that cash flow coming in, versus the folks that are waiting, that can wait, the 4 to 5 years before they get that big hit?
Boy, that's a big question you're asking. Of course, it goes right down the middle of the plate, because that's
Mm-hmm.
a chance too that we're looking in. And
Mm-hmm.
without a desire to invest alternative, they're not going to become our clients either. On a self-directed custodial platform that NuView provides. What causes people to act and not act is a real study of psychology and psychographics and behavior. And I think, you always wish that you could take your story to the right room in front of the right people that are predisposed. Here's our biggest challenge for you and I. The biggest challenge is to break through all of this noise of traditional investments and say, you don't have to do this, and here's why. I think most people undervalue their own ability to figure this out. They've been taught that they can't do this by themselves. This is why you need the green carpet that Fidelity lays out, because you need a carpet layer to make sure that your future is bright. You just follow this path, and those people are always dressed better than you and I. They have a suit and tie on, and and when we understand what the crap is that they're serving up, which is just basically stocks and mutual funds that are banded together by some group of MBAs that have no idea what's going on, and that's what you're eating, they have a hard time getting off that diet, just like people that are used to starting their morning at the McDonald's drive-through. There's a reason it's hard to break those habits. And you're all about that. I'm all about that, because take a look at this and understand it. Understand fundamentally the idea of self-storage and the idea of when do people need it, and how do we figure out where we put them, and how much we pay for them, and how we manage them. All of those things that I saw in 15 minutes, I was just blown away by what you talked about, the fact that you don't even need humans anymore. It's all self-service. It's like this huge vending machine where you can actually store stuff in, and this makes so much more sense. And in the words of our friend from Berkshire Hathaway, Warren Buffett, he says he doesn't invest in things he doesn't understand. I don't think there's anything fundamentally more easily understood than self-storage. We've all used it. We all have friends that use it. We understand how much it costs. We understand how ridiculous it is at times for us to even go do it, but yet we still go do it. We keep stuff that has no value and we'll never use again. All of this stuff makes sense. So our biggest job, I think, together with the people that are watching or listening to it, is to say, don't go along with your habits when they're dysfunctional habits. And I think getting information about investing from traditional investment sources are dysfunctional. And we have to be patient. We can't be angry, because at one point in time, we were that people. We were that too. And somehow we read a book. We got introduced to people. We're now part of a tribe that none of our people in the tribe really believe that way. So it's hard for us to understand people that do. And we just have to love them through the process, teach them through that. And then once they come on fire, and they bring other people with them for self-storage, with self-direction. And we just have to find a better way to get the message out.
So that brings up a good point. As we prepare, we have an email list of folks that follow us, that we produce, give them information, content, and along the way, telling them, many of those things we don't hit so much on. And I know this is something that we should be better at, in grabbing the stats and just looking at just what you mentioned, the Wall Street with regards to the returns, not only the returns themselves, but a very good point is, why would you invest in a company that you have no idea who's at the head of it, what they're doing, the technology, if it is technology or bio life sciences, because it's hot and you know nothing about it. I mean, that's good. And so there's that, along with so many other things. When we're preparing, a slide deck to do a webinar to our folks and present that, let's drill down on that a little bit. What are some of the key items? What is the overall message or bullet points that need to be included in that, to show folks? I mean, I just wrote a note that, that is one of the things that I need to put down is to do a little more comparison against the stock market and other investments that are out there, and let them know that, hey, this is very simple. Why would you invest somewhere else? But along with that, what are, if you were to create a slide deck and say there's, 3 or 4 points that absolutely have to be made, or in crafting this, what should be included to, leave that folks with no other decision other than either the time is now or the time is just not now, but it certainly is yes. It's just not now.
Well, there's a couple points that we certainly talk about. And I think when it comes to actually, obviously we don't offer advice and counsel as to what to invest in, and we're not endorsing public storage or kingdom storage or anything. It's just absolutely intriguing to listen to. And we know that our clients do invest in it. But I think there's fallacies. And I think one way to do that in a presentation is to kind of hit those fallacies head on. What is the protection? Why do you like to be in a publicly traded stock versus private stock in or one of your funds? And you can say one of the major reasons is people feel protected because if they issue stock, it's done under the auspices of the SEC, right? And the auspices of the SEC says you have to fill out forms, right? And you have to declare or publicize, make public certain financial things, right? And when you put an offering memorandum, you have to list all the risks. So that's what you're getting. And you get a 10K every year and you get a 10Q every quarter talking about you need to know how much the principals make. And there's all sorts of interesting stuff to read. I always like to read how much they're paying the principals. But outside of that, I start to get lost and fogged up between the balance sheet and the income statement and the cash flow statements and all of this. Most investors do. But what they don't understand is here's the next column. Here's what you do in your business. Here's our disclosure. You can have all our balance sheets. You can have all the income statements. They're available to you. We can post them up at a certain time. So in other words, okay, so what is it? Is the SEC going to keep you from losing money in a stock? Absolutely not. There's no guarantee. It's a disclosure. So here's all the disclosures. And by the way, do you get to have a 15-minute conversation with the CEO of Microsoft? Hell no. But I can probably weasel that into talking to Scott or whoever's handling your fund. It may not be you, but someone else. So I have access. I have all the information. I have access. If you have audited financials, that's even better. I'm not suggesting you have to, but you would have to if you were publicly traded. And I think that, based on your track record, would blow away anyone's reasoning or logic. The other part is sustainability. In other words, how many times have you done this? That would be a great one, because if I'm comparing this to Ford, I've built a lot of vehicles over the course of the last 110 years. How many public storage have you built or invested in, sold, all that kind of stuff? And my bet is your number is astoundingly high. So you have the ability, I think, to then, of course, the last column would be expected earnings or expected cash flow. And that one you'd blow everybody away, because the difference is on a publicly traded, the amount of money that the stockholders get is after. The amount of money that the stockholders get with you is the management fees and the ordinary fees, like you said. And then it's my understanding on a lot of your deals is you actually participate as if you are a stockholder.
Correct.
Right? And so all of a sudden now, instead of getting a preferred level of return and all this kind of stuff first, and then they get the crumbs, they're along with you. So the structure of the deal would be a great way to compare. So those might be some ideas. I don't know if they're valuable. Let me just follow up with one thing that bothers me a great deal about Wall Street, and it has to do with us preparing about our retirement. Here's the deal. Imagine stepping out of business, we're successful. Let's say we take $2, $3, $4 million and we have it in our IRA. and we've got it invested in the stock market. And I'm 60 years old, and my likely length of time on this earth is going to be about 30 more years that I've got a fund. Okay. And I'm a big time CEO. I'm used to living life large. I'm not used to living on $20,000. I need at least $50,000 or $60,000. Not a lot of money. So what happens is if I look at my earnings aren't going to give me that. So guess what I have to do? I have to start selling my principal to get there. And what's really annoying is I got to sell my principal on all the good stuff that's gone up. So the better the stock performs, the more likely I'm going to have to sell it. What kind of comment is this? And so then I have to look, and this is how most Americans look at their retirement. They say, how long will I live and how long will the money last? And I'm going to presume a 4%, a 3%, a 6%. Well, a lot can happen in your stock market holdings for the next 3 or 4 years that absolutely crater that. So now all of a sudden you're living in a hand-to-mouth situation for your last 3 or 4 years. This is how Americans save. This is what the stock market provides. This is not what you provide, your structure provides. This is not what rental real estate provides. This is not what lending provides. It basically says you live off your earnings and you keep your principal. If it appreciates, great. If it doesn't appreciate, it doesn't matter. I haven't been impacted. In the stock market, you have generally no income. Only about 20% of the stocks actually create an income, and you wouldn't like what they create. It's somewhere around 1.2%. And so I've got to sell that stuff to live. So my principal declines. In the right world, and I believe in when you get to control your own assets, what you're going to pass on to your children and to your beneficiaries and to your charities is going to be something greater than you went into retirement with. That's a much different view. And it fundamentally takes assets like storage and like multifamily homes and single family homes and lending money and all these things. That's what needs to be in there. It shouldn't be Wall Street at all.
Well, and Glenn, that's what I appreciate so much about you. And once again, it was an honor to be able to present alongside of you at your conference, because that is, I mean, that sums up to me, that is the new view. Is that, yeah, traditionally we have looked at anytime you sit down with a financial advisor, and I didn't get that until you brought that up. They divide the amount of years that you have left by how much you have right now and what you have to buy. But then you gamble on the fact that you need to sell those off. You need to accumulate as quickly as possible and then sell it off before you die with nothing left for anybody else. And that just, when you break it down like that, that is so wrong. And it's such a gamble, and it just doesn't make any sense. And there's no guarantees in life, but income producing assets, that regardless of what you said, just regardless of whether it goes up or down in value, that it throws off that income as long as it's managed well. And it doesn't take much to manage it well, or find good managers to manage it well for you. That's how you're able to weather that, the entire duration, and then have something else left for somebody else. And so for anybody else out there that hopefully has, that hasn't heard that before, hopefully that's a new way of being able to look at things. And that's, again, another reason why we brought Glenn on here. So I'm glad you brought that up.
Yeah, happy to do it.
Well, let's do this, Glenn. So let's talk about, we've seen some major changes in how people can direct their investments, and from tax law to, investments, what we can do in and outside, mostly related to tax code, CARES Act changes in that. Bring us up to speed as to a few of the things. I know you've been able to loan against IRAs and do some different things within the $100,000 on both sides. If you would kind of touch on that, and then what does that look like for folks, for the rest of 2020 and beyond? What should folks be looking at right now if they're looking to invest passively and use that through a vehicle like yourselves?
Okay, that's a lot of stuff. I'm going to start back in 75 and zoom back up.
Perfect.
The IRA was created, the traditional IRA, and it became tax deductible a couple of years later. That was created because Congress understood that Social Security would be nothing but a very, very low net, and it's getting lower all the time. And they knew that here's one thing that Congress could do is to give some sort of tax benefits, right, that don't really cost them anything. So in other words, they don't have to fund it. So that's what they did. And then subsequently, they created the SEP IRA and the Simple IRA and the Roth IRA. These are all different versions, and the concepts are all the same. put money in now, except for the Roth, you get the tax benefit now, and then you take it out later and you pay ordinary income tax when you take it. That's what IRAs were all about. So what's happened over these years, since 1975, is actually Congress has liberalized what we can do. And I realize that it's not because they love to give away tax money, it's because they don't want to fix Social Security. So every day that goes by, they don't fix Social Security, they got to make IRAs better. And so, and so we have 401ks, 403bs, 457s, thrift savings plan. That's how America saves. They save in payroll deduction, and then when they no longer work there, they roll it into an IRA. This is the story of how people come to NuView, is they do it because they don't fundamentally have the right infrastructure to save directly in an IRA. So by taking it out of my check, I don't see it, and better yet, my spouse doesn't see it, right? So I save that way. Now what's happened, just to take us all the way up to this current period of time, is the pandemic's here and Congress has to act, and they have to act quickly. And usually when they do it, they don't get it right, but they kind of got it directionally right. $1,200 for people that earn less than $100,000. And then the PPP plan, which had to helping small businesses. And it was a big package. I thought it was a big package of $1 trillion. I thought was a lot of money. But what they decided to do is to go ahead and add more freedom to do with your IRAs and your 401ks. And what they're allowing you to do now is to take $100,000 out. And by the way, people don't understand this, but they also have to have the agreement of their employer to do it. Now, what kind of employer would say no to that is ridiculous, but they have to get that. They can take it out. And ordinarily, when you take it out and you're under 59.5, you have to pay a 10% penalty, and you have to pay ordinary income tax on it. So the first thing they're doing is they're saying up until 12/31, actually 12/30, I don't know why they said 12/30, 2020, this rule applies. And by the way, to actually do this, you have to declare that you've been financially affected by COVID. Now, it's a self-declaration. Nobody proves anything. I'm not to suggest that you should in any case misrepresent your position, but most of us in some way have been affected financially by COVID. So if you check that box, it allows you to take up to $100,000. It can be your complete amount. Usually if you're taking a loan with your 401k, you can only get 50% of it up to $100,000. Now it could be, if that's all you have, you can pull it out. What they will allow you to do is to pay the income tax, because you're not forgiven the income tax. Don't forget that you haven't paid it for most of these IRAs. It's spread over 3 years, and they will automatically assume that you're going to pay a third of it when you file taxes for 2020, and then a third in the intervening 2 years. All right. And now you have the money. Congratulations. Well, you've done a horrible thing. I want to tell you, you've just done a horrible thing, because you've robbed your future for today. So what I would like to suggest is this is a tool, but a tool for you to unlock your retirement plan from your employer. Here's what it can do. A lot of our people that come to our events, a lot of people that come to your events are really intrigued about this fact that they can use IRAs, but they don't have one. They have a 401k and they work for an employer and they're happily working there, but that's where their money is. It was me. I worked at Lockheed. My money was at Lockheed. I was so frustrated until I left. Well, here's the fact, the really exciting fact about the CARES Act. Take the $100,000 out. Take it as a distribution. Don't panic. You don't have to pay taxes yet. It creates a tax liability. And do you realize that anytime within 3 years, you can put it back into an IRA, a self-directed IRA with NuView, and there'll be no tax obligation. Even the tax that you paid and the intervening will be returned to you as a credit. But I would suggest to you the idea doesn't make sense unless it's the end of your rope to ever touch that money. What you should do is take the distribution, it goes into your bank account. The next day, sign up for an account with NuView and roll it there. If you've done that, no tax liability, and you've completely freed the $100,000 because it's going into another qualified plan. And as long as you move it to another qualified plan, you never have to return it to the employer. Never leave money with an employer's plan. Create the earnings or create these savings in the employer's plan, the contributions in the plan. And as soon as you can roll it out and stay working there, do it. This is the only time in our nation's history that they've ever allowed this to happen, and it's a big amount of money. So if someone wanted to invest in all these non-traditional things we've been talking about, including what you represent, they can do that now with their employer's money once they roll it to NuView and make it a self-directed thing. So I'm so excited about this because so many of my potential clients have been frustrated, and I'll bet a bunch that have never even expressed it to you have been frustrated. Those doors are open up until December 30th of this year.
Well, and I'm surprised at how few people are doing it and how much the lack of knowledge and education there is out there. When I heard about it, I thought, my gosh, why aren't people shouting this from the rooftops? Because yeah, this is huge for so many people. But once again, that goes back to the herd mentality, as we discussed, and people are just plain comfortable, and change is not so good. But yeah, this we have felt, we've been preparing for this recession. Those of us that are in commercial real estate, or perhaps real estate in general, since 2011 and 12, and we have been gathering our equity partners to come alongside of us and helping them to set up their self-directed IRA accounts with you so that they can invest in our projects. And we have been making more connections and relationships with lenders because we knew that, eventually, well, there's always a recession. There has been, since the beginning of time, every 7 to 10 years, we knew it. It's not like we've had the last one in 2008. We knew it was coming. And so we've been, battening down the hatches, but as well as building up a war chest. And so we didn't think it was going to happen this quickly. I mean, when Lehman Brothers fell, that was the beginning, and it was real estate and financially created in 2008. This one, we thought we'd have a slow burn and maybe a 90-day, keeping an eye on, the yield curve and everything else. But then lo and behold, this little pandemic has really thrown us into a recession. Either we're in it or we're not, depending on what you believe. I mean, let's face it, we are, and it happened pretty quickly with unemployment rates. But to be able to have the ability to do that, we feel that we have this window while interest rates are low. We have sellers of these facilities now that do want to sell, and across other areas in real estate, and we have folks that have this ability to now take money that was not doing very well or that was locked up in an IRA and get it into other asset classes, whether it's with us or in self-storage or anything else. This truly is a perfect storm. And those of us that are in real estate, and especially in self-storage, we've got a good story to tell. As we're in the trauma and transition business, and storage is filling up right now, and we're seeing that absorption as we always have. And this is going to be the biggest land grab that we've seen in my history in real estate, especially in self-storage. And so we're extremely excited about our prospects. But with that, Glenn, tell us then, what is, that's through the end of 2020. If you could, get out your crystal ball, and what does this look like into 2021 and 2022, say, even as we head into this recession, what do you see happening, and where do you think the opportunities are?
Oh boy, don't do that to me. I mean, that's really an unfair thing. And you're asking me to put a hat on that I shouldn't be wearing. What's interesting is I want to suggest that Wall Street isn't full of very, very wise people. I think they are. From a standpoint of not necessarily where I can make money through that wisdom, but when it comes to the cost of money, I think the cost of money is the best forecaster, I think, of the economy than anything else. I mean, we can sit and argue about, does it matter whether Democrat or Republican? You take a look at at a 5-year, I like to look at a 5-year, and I like to look at CDs more than treasuries, because treasuries have other issues associated with it. But, this is basically, CDs are instruments that banks put out, because they have excess, they're trying to gather more money in as deposits to a bank. And they kind of figure they're going to pay as little as they can to get those deposits for as long as they can have them. And so right now, that interest rate is 0.5% for 5 years. That's about what a vanilla CD at a bank that's got 4 or 5 stars, which is the top banks. That's what they're offering, 0.5% for 5 years. So I'm not sure my prediction of saying, hell no, I don't believe that. I believe that inflation is going to run rampant. We're going to be up at 8 or 9%. I think that would be foolhardy for me to be able to overcome what people are that are buying and selling cash look like. it's going to be. So it's going to be a very low growth. Now, everybody talked about this recovery being like a V or a U, that we were going to slide down, hit bottom, and then bounce along a little bit, but not much, and come right back up. We got a cure for COVID, et cetera. And I think that works as long as our fundamental ability to manufacture and to consume, and a desire to consume, if those match up, and are they in the same place as they were before? And I don't know the answer to that. I think it very well could be. I mean, it hasn't been that long. It's not that disaster has crept in and that we can't recover. And maybe even getting a new president, a different president, despite some people saying that it's the current one that really understands the economy, maybe having another pair of fresh faces builds consumer confidence. We have to understand that the consumer is what really drives the economy here. It's not the producer, it's the consumer. I think it could come back. I think that there's a bit of pessimism, too much pessimism in the market from a standpoint of cash. That you've actually got to go bury it in the ground for 5 years. I don't think that's the case. We could emerge from this stronger than ever. We don't have world wars right now. We have conflicts, but not wars. We don't have the terrorist activities that we were facing before at the same level. We actually had a very historic peace accord or deal struck between Saudi Arabia and Israel that was completely off the radar. Who thought that would get done? So I'm not suggesting that peace is breaking out all over the world. We have some deep discontent. But I think that all of these things can get better. And I'm a little bit more on the pessimistic side. And that's why I like to keep investing through this rather than pausing and hoping that things get bad. I think a little bit of investing is emotional. There is no doubt about it. And I want to feel good about where my money is. And I want to feel good about it being invested. And that's another reason I like private investment. I can invest, by getting to know the CEO and getting to know what they stand for and getting to know what their worldview is and getting to know all this stuff. It's important to me. It may not be important to other people. It may be just the dollars, but all of that's important to me. So I choose to be a lot more optimistic. I'm measured in my investments, but I got to be invested. I can't pull all my stuff off and prepare my family for the year and the year after that.
Well, for me throwing you into that position, you did a very good job of answering that, and also holding the line on both optimism and pessimism. So I share those same views. I am optimistic with what I'm sure about, and the things that I can see in the economy that, again, no guarantees and no 100% surety. But we can look at areas of the economy that do well during a recession or that are recession resistant and do well during good times, where I'm still not having to time the market like almost every investment in the stock market and the stock market as a whole. When people are, when people begin pulling out cash, everything goes down, whether it's a solid business or not. Hard assets and just other investments, they're just not affected by that. But I also do share a healthy bit of pessimism as well, to think, wow, it doesn't take much for people to think that things are doing good again when there's some positive news out there about certain areas and sectors of the economy. But let's not forget that we've thrown out a whole lot of cash into the economy right now. That is, there's going to have to be a reckoning for that at some point. And I believe that, once the aid and the stimulus checks have run their course, and all the folks that we are at record number of people that are unemployed right now, that is going to take an effect on the economy. And you're right, it is all driven by consumer confidence. And so I think when people begin to run out of money and the support and the true pain as their savings go out from their day-to-day living expenses, then that's when we're going to see a bit of a slide. And again, we don't celebrate pandemics, we don't celebrate recessions, but in the storage sector, we know that trauma and transition, when people have to downsize, businesses downsize, and they move in with each other, that's the place where we continue to do well. But we doesn't mean that we're not keeping our ears to the ground and our eyes looking way forward, because this is uncharted waters that we're in right now, and not exactly sure what this is going to look like.
Scott, if I can just add one thing quickly.
Sure.
we're in the COVID economy. This is an economy that's simply all wrapped around COVID. Nothing else caused this economy to take place. It wasn't policy. It wasn't people. It wasn't politics that caused it. It was that. We've got to understand that, and that's going to be for a tangible period of time. Unless we believe that the antibodies and the vaccines and the treatments aren't going to get that to a low enough level where it may even exist, but it's not talked about primarily. So if we believe that's going away, how can we predict, to me, how can I predict a 1%, return on a 10-year treasury? I can't. I'm too optimistic for that. And I do think that we're going to do this. The other thing is, fundamentally, this affects consumer confidence. We have a political system today where one side is going to win if the economy gets crushed. So understand, if that's what you understand, then every news story is going to be tilted about poor Auntie Sue who lost her job and stuff. And none of those unquestionably are good news, etc. The media focuses on. And so if we're focusing on recovery and focusing on how well we're doing, that builds customer confidence. It has a lot to do with our voices need to be counteracting that to say, look at where we were. This is a COVID economy. And we can argue about whether or not the current administration or Congress or whatever made the right moves. But in essence, today, it doesn't matter. It's saying, where are we going from here? And so I think it's an artificial economic situation that will come normal, and it's being exacerbated or magnified by the political warfare and the struggles going on. And I think those are two reasons I feel optimistic. After November, those struggles will be over, and whoever wins, wins, and it's going to become the new normal. But the economy that around COVID is not the new normal. It's going to go away. It's just a question of when that's going away.
Yep, I agree 100%. Well, Glenn, once again, thanks so much for your time, and we've gone way over, so I appreciate you dedicating even more time, but we've covered some incredible topics, and I appreciate, as always, your views and your input. Before we wrap up here, tell us what are some of the best way that people can get in contact with you and introduce themselves to NuView if they aren't already?
Yeah, the best way is just to go to our website at NuView IRA, and we misspell it intentionally. It's NuView IRA.com. You'll see discussions like this and a lot more information. The other thing is just call us and have a conversation. It's okay. You won't be sold to. You're just going to be talked about what are the accounts you have, what can you do. Maybe this CARES Act opportunity, this window may be opening and you don't quite understand it. We didn't talk about it much. We're here to be resource, access your funds, and you can make all the best decisions on them. We'll help you with the different types of accounts and the way it works, and we will be with you as you go through this process. We all had to learn, as Scott and I talked about, why do people act the way they do? It's because they don't have the education, and you don't get the education all at once. You have to watch, you have to listen, you have to go by reputation. And with all of that, we stand ready to help you. So it's NuView, NuView IRA.com. And I look forward to talking to you. I'm accessible too, so you can always ask for me, and be glad to talk to our clients and potential clients as well.
Fantastic. Well, once again, Glenn, thanks so much for your time. And we'll have to do round two. This was wide ranging, but there's several other topics that we could touch on and a few others that we could probably dig in a little bit deeper. So if you're up for round two, we'll make that happen.
Absolutely. Thank you so much for the opportunity of meeting all your friends online.
All right. Thanks, Glenn. Take care.
All right.
Ladies and gentlemen, thank you for listening as always. Now, we're going to be talking about topics like this that are on target for the times that we find ourselves in. So it is important that you are listening to this podcast every single week, because the guests that I'm going to be bringing on and the topics we will be covering are relevant to what we are all going through right now. And it's just going to get better and better and better in terms of the content that we're going to be discussing, and it's going to be more timely than ever. So please, make sure you subscribe to the show and make sure you're paying attention to these episodes as they are coming out during this period, as I am specifically going out and finding guests who are providing really valuable information you need right now. So thank you so much. We'll see you next week.